Hello, everyone, and welcome to our very special market alert video. And we wanted to get this one out to you, given all the volatility, how far down the market has come, the tariffs, the potential for a government shutdown. We have inflation. I mean, it's like everything is happening all at once. Probably you're feeling a little bit anxious. And so our goal is to always answer your questions before you even think to ask them. It's our core value number 4, right? If you call us about something that we should have told you about, then we lost. So that's what this is all about. And so I want to go over with you everything. But first, let me just tell you, yes, I am in bed. And yes, I'm still recuperating. It's been a week now since my left knee replacement surgery, and it's going pretty well. Yesterday I had a lot of pain, but today's better. So all is proceeding accordingly. So thanks for bearing with me in bed and all the rest. So let me bring Jordan Roach, our Chief Investment Officer. So Jordan, if you could join us. Good afternoon. How are you?
We're great. We're in Houston area earlier this week, and it's a little calmer, a little sunnier. Power's on. Things I think y'all have struggled with in the last
Yeah,
24
we
hours.
had we had a terrible storm. We had power outages everywhere. My neighbor's trampoline, a 20-foot wide trampoline, was removed from his backyard and deposited in the neighbor's 5 houses down's front yard. So
It's a
that's how
nice little
strong the
gift.
winds were.
Yeah. Okay.
So let's talk about, what are we going to do if we hit our sell signal? What are all the drivers of all of this? What's all this, what does it all mean? Let's put it into perspective for our clients and our squippers. So let's start with, first of all, tell us, Jordan, where have we been and where are we now in terms of our sell signal, in terms of coming to the point where we're going to sell?
Yeah. So, who knows where things play out in the next few weeks? In the last, let's say, 12 months, we've been as high as, 15% away from our sell signal, and then we've been kind of where we are today. So, as Tuesday, at least of this week, we were roughly just under 6% away from our sell, meaning we could soak up roughly another 6% downside on the S&P, and then that would cause us to be making a decision about selling. So we have some room there, which is a good thing. So the interesting thing is, this is where if you look at where the S&P 500 has come, I think it probably feels worse than actually what's happened. So the S&P is down just over 6% from its highs, and we got another roughly 6% to go. So that's the good news is we have some room there. We've already soaked up a lot of the downside. And then we just, again, have a little bit of room to help us soak up any sort of uncertainty, volatility that might be coming in the next few weeks.
Okay, and so one of the things that we've always talked about over the years with clients is that, even though it feels terrible, when the market goes down, the closer we get to our sell signal, the lower the downside risk becomes. So it's not like there's this endless abyss below us where, we're going to fall to the bottom of the ocean. So the fact that we've gone down this far means that we've already taken out like half of our downside pretty much at this point, right?
That's right. I mean, the way, clients kind of are feeling right now about whatever they've soaked up, realizing it or not, it shouldn't feel that much different if we get there because we're about midway in there. And depending on how the rest of our portfolio performs, everything else, it can help soak that up. But that's right, is, for us, technically with our sell signal, the riskiest position to be in terms of like looking at max loss is when the markets are at all-time highs. That's as far as away we'll be, the most loss. We get closer and closer, it doesn't, and everyone has that feeling of this doesn't feel great. But technically, almost in some ways, it can be more optimistic.
So the closer we get to our sell signal, the safer our clients should feel and our squippers should feel, as opposed to, oh my gosh, it's gone down so
Yes,
far, and I'm feeling more and more nervous. It should give you a feeling of peace of mind that we're getting closer and closer to getting out. There's not this endless abyss below us.
that's
And
right.
so for me, it gives me peace of mind. And in fact, we've talked in the past, Jordan, about how, if you get really close to our sell signal, that could actually be a fantastic time to buy, right? Because your downside is so small. And if it doesn't trigger you out, the upside is pretty great,
That's
right?
exactly right. I mean, the hardest thing I think for investors is going to be to ever quantify your downside. And the good news with our sell signals, we can do that pretty easily. And so the closer we go to what your known expected downside is, depending on what other parts of the portfolio do, but the closer we get, And the tighter that downside is, in theory, that means the more upside you have. And
Yeah.
so it's almost counterintuitive.
Yeah. And so yeah, it actually it's interesting. But if we're like 2 or 3% away from getting out anyway, for me that's an optimum time if I have cash to buy,
Right.
because yeah, I could be wrong. It could go down, and I lost that 3% or thereabouts. It's not
Yeah.
perfect, but
Right.
if it doesn't, if it swings back around, then the upside could be 10%. So
Absolutely.
it tends to, so the closer we get, the less risk we have. So that should give peace of mind. So let's talk about the other side of the equation when it comes to our investments and all that. And that is that even though the market has gone down so much, we think of the market as one thing,
Mhm.
but we're diversified, right? And the market is not just one thing. So tell us about the different components of our portfolio and how they've done, and how, in fact, as we record this, we're up for the year still, even though the market is down.
Yes, I mean that's right. Always on this video, I think for most people, we always say talk the market is just like one homogenous thing, and it's not. There's all sorts of slivers of it. There's big U.S. companies, there's small U.S. companies, there's international companies. And for our clients, yes, it is true that most of their equity, their capital, their stock is going to be exposed to big U.S. companies, but we got a pretty healthy part amount in other parts, not to mention bonds. And so, while big US companies have been on a little bit of slide here, international, for example, has done really well this year. And that's bolstered us. I mean, international, while US markets are largely down across the board, international's up, well into the single digits, almost double digits.
Yeah, it's up
So
over
that's helped.
9%.
That's right. And if you look at, bonds, while stocks are sliding, we're finally getting that diversification benefit from bonds, where bonds are going the opposite way.
Yes, finally the
Yes.
bonds have.
That's right. So we're getting that, which is nice. But we're seeing, mid-cap stocks and small U.S. companies, they're going to sell off even more than big U.S. And that's not necessarily surprising. I mean, for as a general rule, biggish companies have better balance sheets, they have more access to capital, they are safer. And so if there's perceived risk for whatever reason going forward, typically smaller U.S. sized companies take a bigger hit. And we've certainly seen that. But if you look at large, yes, we got some parts of our portfolio going down, but we have other parts going up.
Yeah. And what's reported in the news is always large, right? It's always the S&P, it's the Dow. So that
Yep.
kind of gets our attention. But like you just said, the international part of our portfolio has done incredibly well so far this year.
Yes.
It doesn't guarantee it'll continue to do so, but it has.
Right.
And as you said, bonds have done well. The anticipation that the Fed's going to lower interest rates, bonds have finally started to behave the way we thought they would. So that's a
Yep.
good thing too.
Yep.
So let's talk about, I'll call it the three horsemen of the apocalypse. Okay. So
Okay.
tariffs, inflation, and something that is going to be front and center if it isn't already, and that is the coming government shutdown.
Yeah.
So let's talk about the tariffs first. So,
Okay.
you know, right now, one of the things that, I have kind of taken away from these tariffs that have been put in place with China and with Mexico and Canada, these 25% and 15% tariffs, the administration has gone out of their way over the last few days to say this is not a trade war, this is a drug war, meaning that these tariffs have been put in place to basically get the Chinese, the Mexicans, and the Canadians to shut down the flow of fentanyl into our country, and to shut down the illegal immigration into our country. And so if that is in fact, if you take them at their word that if those things go away, the tariffs will as well, then what does that tell you? What do you think?
Yeah, I mean, I think that's the best base case is to say, let's take it for face value because we can guess and pontificate and think, well, he's not being truthful, he is. We don't, so therefore all these scenarios come into play. But I think the best course is to say, let's take with what they're saying. Okay, what could happen? So that means effectively, if that's the case, tariffs can come on or off the board very quickly because the solution, the fix to that, in terms of having talks across the table with those other presidents, those other countries, it's far easier to find a solution than if this is all trade driven, deficit spending issue, all those things. And so we absolutely could see a scenario where tariffs come on the board. We've already seen this come on and off. They come back on again, And then who knows, in the next week, some of those could come off the board again.
Yeah.
And
And as
so,
we record this, the news is that apparently Trudeau and the president of Mexico are going to speak with Trump today. And so it may be that as we record this, they're making an
yeah,
announcement as we speak that, hey, tariffs are off. We don't know. But our view of it, and I think we're in agreement here, is that these tariffs are not designed to be a trade war. They're designed to address the immigration and the fentanyl thing. And those it should be easy fixes for China and Canada and Mexico to address. And and
yes.
and if they do, everybody in the administration so far has said that just about all of those tariffs would go away. So long term, we don't see these tariffs, even though they're causing the market to be uncertain right now and causing this volatility. We don't see that as being something that'll be with us long term. So let's talk about inflation. Um, so right now, where do you see inflation going? Fed action, going forward, and is that something that inflation is going to rear its ugly head and cause everybody to freak out, and the market goes down, and we have to sell?
It's hard to say. I mean, I would say long term, I still think inflation is on the disinflation path. Okay, and obviously there's uncertainty. I mean, if tariffs stick for long term, then the base case that everyone thinks, which sometimes leads me to take the other side, is that those could be reflationary. They could be. But if they go to what we say face value, they're coming off the board and they're not just going to be long-term sticky issues, then I do think we're going to be on the path to disinflation. And we've seen it come down from the peak. The question is, do we keep going to 2%? Do we hover in that 2.5, 3% zone? Where does it go from there?
Yeah.
And so if we think, inflation kind of holds or moderates, and it's not going to be a straight line path. We've seen that. We've had a couple, inflation scares in the last 2 years where just for 1 month the reading went high, causes markets to get jitters, like you've talked about. But I think we think the path is lower. I think, if you look at what the Fed was, well, at least what the market was pricing in terms of Fed rate cuts 2 months ago versus even now, we put a couple more back on the board potentially.
Yeah, now we're talking about three rate cuts again.
Right.
And in our fearless forecast, we said that, the Fed was going to lower interest rates in May, took it off the table given the inflation number we got and said now it's June. But now the market is coming back and saying, no, 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 it's going to happen in May, June.
Right.
We're going to get three of them this year. So the
Right.
market's pretty emotional when it comes to this stuff. But our view still is that, maybe one or two rate cuts. But the important thing is not whether when they do it, but it is the trend. Which direction are we headed in? And therefore, the sentiment of investors, the bond market, the stock market.
No, that's right. I mean, that's where we're trying to, I think we get that path. The overlay here, kind of maybe like a cousin that we could look at in terms of just, market behavior and underlying dynamics would be kind of a 2018 scenario. So 2018, even take President Trump aside, there are a lot of similar things there versus now. I mean, obviously the president's the same. Tariffs started against China then. We had inflation that was very, very low for a long time, and then it started coming up a little bit. It was still low historically, but started coming up a little bit. You had the Fed deciding what they were going to do with rates for the first time really since the financial crisis in '08. And there was a lot of volatility in 18. And so some of those same things, I mean, most market participants, investors, are going to be historians, and they're going to look at past cycles, figure out what's like, what's not, and sometimes, rhyme with those until something changes. And so I think right now, as there's a lot of similarities between the start of 18 and the start of 2025.
And what happened?
Well, 2018 effectively was the market didn't go anywhere. It was down about 6% for the year. Volatility, kind of a sideways market. And where 2018 changed is when the Fed changed. The Fed went to, we're pausing rates and then we're going back down again. The market lifted. So it's really
It
not that
shot
it's
through
not
the roof. In 2019, we had a phenomenal year.
In 2019, you flew. I mean, 29, and we could have a 2019 like this. 2019 year, that's where really the trade wars with China ramped up, back and forth. You saw, a couple 5% corrections. You saw a 7%er. You said day to day and month to month volatility picked up, even relative to 2018 almost. But that was a 30% year for the market.
Yeah. So volatility is and uncertainty and tariffs and inflate all these things. The market, there's a famous expression that says the market is not the economy, right? And so You have to investor sentiment and what they're looking into the future. So a lot of times the market looks past these things and says, okay, what's the logical outcome of this? And yeah, there are tariffs, and yeah, there's this and that, but the trend is this direction, and therefore, we start to see a very positive outcome, even though the news is all terrible. Okay,
Right.
so let's talk about the government shutdown. Um, so, so this is like, one of my favorite lines in the James Bond movies is, this guy, the bad guy's trying to kill Roger Moore over and over again, and James just finds a way to survive everything. And so Bond appears, and he goes, "Mr. Bond, you appear with the regularity of an unwanted season." And so I thought that line was really funny.
Yeah.
So these government shutdowns appear with the unwanted regularity or with the regularity of an unwanted
Yes.
season. It's like, man, it's like every time they can't agree on it in advance. They got to wait till the last possible moment, and then everybody's jockeying for position. And
Yeah.
so, what's your take on the government shutdown and how that would affect our investments?
I mean, I would love to see for once an agreement 24 hours in advance of the deadlines. But we probably are going to get it, right? We
No,
just know what's going on. We're not going to get it.
no.
So, volatility leading up to that deadline, historically, it picks up almost every single time. Not every time, but the volatility, the down days usually picks up leading into that. But at the end of the day, usually 1, 2, 3 months after the market's very healthy because this is an exogenous issue that everyone pretty much knows we're gonna find a solution. And so the market will hem and haw. The market could sell a little bit. The market could create some, could have some uncertainties, but it most likely will find it settle. It'll resume, and the market runs. So that's one of the conversations that we're having is saying, if we get into a scenario where that caused us to reach for our sell, we'd have to take that into consideration to decide what do we want to do.
Yeah. You know, the thing about the government shutdown is that if it were to happen, well, not a government shutdown, but if we defaulted on our debt, if we decided, you know what, no, we're not going to resolve this, there will be, a permanent, we're not paying our debt, it would cause the greatest depression in the history of the world because America's economy and the dollar is kind of the oil that greases all the wheels everywhere. And if suddenly the world decided they cannot trust the Americans to pay their debt, and the world said we can't use the US dollar as its currency anymore, the repercussions of that would be so enormous. We would have a Great Depression of bigger probably than the one we've back in the 20s. And I think, both sides, the Republicans and the Democrats, understand that this is such a horrible outcome that
Yes.
no matter how vested you are in whatever position you're taking, in the end, we're on the same side here because we're both going to get killed. Again, I'll remember, in Raiders of the Lost Ark, somebody may remember this. There's a scene there where they're inside the cabin in the mountains, and where they're doing the shots of tequila or whatever
Mhm.
that was, and then the whole place catches fire, and Indiana Jones is fighting with this one guy, and the Nazi guy goes, kill them both." And Indiana looks at the guy he's fighting, and they're going, "Shit, they're going to kill both of us." And so they turn the gun and they shoot the Nazis instead together. So if they realize that,
That's
boy, I
right.
wonder if that word's going to get deleted from this. But if the Republicans and the Democrats both understand we're both going to die, I think we'll get past it. Okay, so that brings up this question then. All right. So yeah, the tariffs, yeah, the government shutdown, yeah, inflation, all of that. But what happens if one of them, two of them, or three of them all come at the same time and they conspire to bring us to the point where we hit our sell signal? So, one of the things that I want to assure everybody is that when we hit our sell signal, it's the law. We will sell. There's no question about that. The only question then is, what do we sell? How much do we sell? That kind of stuff. So can you expand on that, Jordan?
I mean that's it. So the sell, the trigger is meant there to say that we are making a decision. Something is being sold. We are going to de-risk. We're going to be mindful the market is saying that something is off, and we will never ignore that. But we absolutely have to consider, exogenous things that we think could resolve themselves, and maybe depending on what it is, of what's causing it. But if we think there's exogenous events that are most likely going to be resolved within days, weeks, months, versus we're getting there because we're seeing all these economic indicators and monetary stuff flashing that's just saying there's just something amiss. Those are different scenarios that cause us to have maybe a different decision at the trigger. And so we don't know yet. We don't know one if we're going to get there. We certainly don't know what's causing us to get there. And it's always hard to pinpoint it unless it truly is an exogenous event. But that's what, we have great discussions about to make sure we're thinking through it correctly and we can come up with a convicted choice of here's what we're doing.
Yeah, and as you were saying all that, I was thinking, what we always tell clients is let us worry about it and get the gray hairs for you. You're too young to get gray hair.
Well, they're coming.
Although
They're coming
although
quick.
I'm seeing some right here.
Yep, it's coming in quick. That's right. Just a
I
few
mean,
more
look at
years on the
me.
job.
I've been doing this now for what, 30, 40 years.
Yeah.
Man, I got the gray hair
Yeah.
to show you. You're still a young pup. You don't have the gray hair yet. So,
Yeah.
Jordan, thanks for helping us understand all of this. I appreciate your comments.
My pleasure.
So,
Thanks, Ian.
so I hope that, ladies and gentlemen, that this video helped you to get some feel for, our thought process. I want to assure you that, we've thought about all the different scenarios. I mean, not all of them. There's probably one we haven't thought of, but we've spent a lot of time thinking about what we're going to do if this, if that. And so we're minding the store for you. It's our job. And as I said, we want to worry about this so that you don't have to. Your job is to be a squipper, go out there and play and have fun and enjoy yourself. Let us do the worrying for you. Let us get the gray hair for you so that you don't have to. I hope you got a lot out of this video. I hope it gives you peace of mind. That's our goal. And I also hope that you will share it with as many of your friends and family as you possibly can. And also make sure you like and subscribe to this video. Super important for us. And having said all of that, I hope it found you healthy, wealthy, and wise. And we'll talk soon.